Good afternoon, everyone. Today I am making this video to go over the financing contingency that appears in the offer to purchase. So I just want to get to the offer itself, and I just thought I'd go through this page, kind of let you know what everything means, what goes on each of these lines, and we'll take it from there. So this is the financing contingency. Please make sure that if you're going to use it, you do check this mark right here. It's important that you have that because, as it states in the contract, if you're going to use something within the contract and there is a check mark to indicate the use of it, make sure you do that. On this line here, line 217 and 218, this is where you're going to put in the type of financing the buyer is going to be getting. Now, you could put in like a VA loan, WIDA, conventional, anything along that line, you'd be able to put that in here. You can, although I would not necessarily recommend it, but you can get specific as to where you're going to get this loan from. So you can say conventional loan from Bank of Peter. So you would be able to specify exactly where you're going to get this loan from. Wouldn't necessarily do that, and if I was representing a seller, I don't know as I would necessarily allow that to go forward. Remember, anything in an offer can be countered. So probably your best bet is just to make sure you put in here the type of loan that you're going to be getting. Now, the next line here is how long will you have before you're going to be able to get the loan? This is when you have to have financial commitment from the bank. I would always recommend that you do at least 40 days. For the average transaction to take 45, I always recommend that you do 40 days. But depending on your circumstance, you might want to make this longer or shorter. But remember, by this date is when you need to have the loan commitment sent to the seller to, or you do risk the possibility of losing out on this offer. So I'm just going to leave 40 days there for now. This is where you put in the amount that is actually going to be financed. So let's say, for example, we're writing an offer for $100,000, and the buyer is going to put 20% down. Well, you're then going to be financing $80,000. Whatever amount the buyer is going to be financing, that's what you put in here. Some loans like VA and WIDA, you can do 100%, so you would be able to put the full $100,000 here if you want. But also remember, you're probably going to be paying earnest money, which is not money that's going to be financed, so then you would probably want to reduce this amount by however much your earnest money is going to be. Let's say in this case it's $500, it's a $100,000 house, you're now going to finance $99,500. So you got to do a little math to determine exactly how much it is that you're going to be financing. This is where you put in the term of the loan. How long is the loan going to be? And this you will normally either find on the pre-approval letter, or you might have to get the information from the buyer or the lender to find out exactly how long it is. More often than not, this is going to say 30 years. So it's going to be a loan of 30 years, amortized over 30 years. In other words, they're going to calculate the payments as though it were 30 years. These two numbers do not have to match. If they don't, you're looking at a balloon payment. So let's say this is going to be a loan for 10 years, amortized over 30 years. What that means is they're going to be making monthly payments as though it were a 30-year loan. But once it gets to the 10 years, they have to pay the whole thing off at that point. These numbers, again, like I said, can change. Let's say they're getting a 15-year mortgage. So it'll be a 15-year mortgage amortized over 15 years. So just make sure you're in communication with your buyer and their bank as to what the financing term, the length is going to be. But as I said before, most of the time it's going to say for a term of 30 years, amortized over 30 years. This is where you put in, on this line here, is where you put in the monthly payment. This is principal and interest only. This does not include taxes and insurance. All of you should have a mortgage calculator someplace, whether it be on your phone or on your computer. You can go ahead and do the calculations. I'm guessing at what the calculations are here. and that's going to be around $530 a month, we're going to say. Do get fairly accurate with this number. It's important that you do. So make sure you have a mortgage calculator someplace. I have one on my phone, so no matter where I can go, I can calculate a person's mortgage payment. You'd be surprised how often I do that. So that's what goes here. Now, right here, what this is the mortgage company, I'm sorry, right here, we'll start. Buyer agrees to pay discount points and or loan origination fee in an amount not to exceed. My recommendation to you is always to put in 0%. There was a time when getting a mortgage, it was popular to call or to pay points. What that was is strictly a means as to which you would be able to reduce your interest rate. This was done primarily when interest rates were 10, 9, 8%, something like that. You would be able to pay a certain amount of money up front, and then the bank would lower that interest rate, let's say from 8% to 6%. This is where you'd put in how much money you're willing to pay up front to the bank to get that loan. Also, there are some mortgage programs for people whose credit is not great, where they do have the ability to still get a mortgage, but they do have to pay some points, some money up front. And this is where you'd put in the percentage of the loan that you would put in. So if you put in 1%, again, this is a $100,000 house, the buyer is saying, I will pay the bank $1,000 over and above all the other costs in order to get this mortgage that I've just described right here. So again, my recommendations normally make that 0, but talk with your bank and make sure that you have a good understanding of what the financing is going to be. Talk to the buyer. It's worth your time to take a little effort to make sure you get this right, because this is a contingency that you will be able to use if in the event you're not able to get financing. And if you do not complete this correctly, you'll make it more difficult for your buyer to be able to withdraw their offer if they need to. All right, so now we go down to the next section. We talk about whether it's a fixed rate or adjustable rate. By far, more often than we get fixed rates, and usually as of today, interest rates are around 5%. I always go about a quarter of a point higher because they do float. And you do want to be able to handle that float during the length of the transaction. Now, normally this interest rate gets locked shortly after the transaction is accepted, but you still want to make sure you have a little bit of fudge room here. I always recommend a quarter point. I also recommend that you check on at least a weekly basis what the current interest rates are for mortgages. What is starting to become a little bit more popular are people looking to do an adjustable rate mortgage. This you're going to need a little bit more information on. So if your buyer is going to have an adjustable rate, you click the button here, and then you have to put down 4 different types of information, not just the interest rate. First thing here is the interest rate. What is the initial interest rate? Right now I'm seeing it at about 4.125 for a 4.125 for an initial interest rate for the number of months, usually like a 5-year arm, that would be 60 months. Then the next thing you need to talk about is how much will it increase per year after the 60 months? What is the maximum it can increase? Usually it's about 1%. And then what is the maximum interest rate it can ever be without the bank being able to raise it any higher? That's usually about 4 or 5 points above the initial rate. So what you need to do is if you have a adjustable rate financing, you need to know what the initial rate is, how long the bank will allow that initial rate to stay. After the 60 months, what is the maximum it can move the interest rate up or down? In this case, it's 1%. And here, what is the maximum interest rate it could ever be if the bank continuously moves it up once a year after it gets to the 5 years? Just because you have this, it could move it up 1%, and this could go up to 8.125, doesn't mean it has to. It's just this is the worst case scenario. So we need to be able to make sure we put that in the offer too, as to what the financing is going to be like if it's an adjustable rate mortgage. Here, if buyer is using multiple loan sources, which quite frankly, 15, 16 years I've been doing that, I've never seen multiple loan sources, or obtaining a construction loan, yeah, I've seen that, or a land contract, that too, describe at lines 165 through 172 or 435 to 442. These are the lines for the additional provisions where you would have to write them in, or an amendment attached per line 434. This you're not going to run into very often. If you have a construction loan, usually the bank is going to be able to give you the terms of that, and you should easily be able to fill that into the additional provisions. Or you could put it up here where you would be able to put in construction loan. And then be able to spell out the terms here. If the lines provided here do not allow you to adequately describe what the financing is like, then go to the additional provisions and fill that in. But you do have the option here. If you're going to be doing a transaction with a land contract, have their attorney complete the land contract. I recommend that we do not do that. As agents, you cannot do that. As a broker, I could. I personally do not do those because I believe this is something that should be done by an attorney. So please make sure that if you're going to be doing any financing with land contract, you put a contingency in there stating that the land contract will be written by the seller's attorney to be and have time for the buyer and the buyer's attorney to review it, approve it, and then make any changes if they need to. All right. So now this here is the basic minimum terms as to which your buyer will accept to go forward with the purchase on the property. So if your buyer is able to get these terms or better, let's say the interest rates go down. Let's say they come into a windfall for $10,000 that they're able to use for the house and they don't have to finance so much. That's fine. This is just stating to the seller, this is the minimum terms that I will accept to go ahead and purchase this property. And that includes this section 2 is what the interest rate, whether it be fixed or not. All right, so now we go through the transaction, everything is going smooth, everything is going fine. Now it gets to be time for the loan commitment. What this line here is, or this section talks about, is the proper way to deliver loan commitment. And if you ever want to see me get upset, either talk about whiting out a contract, which an agent did yesterday, and I darn near had a heart attack, or don't deliver loan commitment the proper way. And there is a specific way to deliver loan commitment. Now remember, this commitment has to be done within 40 days or whatever number you put here after the accepted offer. So let's read what this says. Buyer agrees to pay all customary loan and closing costs, to promptly apply for a mortgage loan, and to provide evidence of application promptly upon request of the seller. This does happen sometimes. The seller might want to have verification from the buyer that indeed you did apply for the loan. If buyer qualifies for the loan described in this offer, and this is important, or another loan acceptable to the buyer, and let's talk about that. As I mentioned before, this is what I said would be the minimum terms the buyer would be able to accept. But during a transaction, some of these terms might change, but the buyer would still be okay with it. If the buyer is okay with it, you can still go forward with the purchase. And I would imagine if it's less than this, of course they're going to go forward with it. But let's say, for example, we find that the interest rate has ticked up a little bit. Let's say it's 4.25%. The buyer can say, you know what, it's not what's in the offer, but I still find it acceptable, so I'm going to go forward with the purchase. So just remember that it has to meet these terms or another loan acceptable to the buyer. Here, the buyer agrees to deliver to seller, let's read this again. A buyer agrees to deliver to seller a copy of the written loan commitment no later than the deadline in line 219. Buyer and seller agree that delivery of a copy of any written loan commitment to seller, even if subject to conditions, shall satisfy buyer's financing contingency if, after review of the loan commitment, let's just look at that. After review of the loan commitment, this is why you have the buyer sign the loan commitment, because now you're able to show that the buyer has reviewed it. Buyer has directed in writing delivery of the loan commitment. This is where you have to get in writing from the buyer that they want you to go ahead and share the loan commitment with the seller. This can be an email. I've seen a lot of people do this with a notice, which I think is a really good idea. The notice just says buyer authorizes agent to share loan commitment with seller. So, all right, buyer has directed in writing delivery of loan commitment. Buyer's written direction shall accompany the loan commitment. So what that means is the buyer's written direction, whether it be that a copy of that email or that notice, has to be delivered with the loan commitment that's signed by the buyer. And now you have properly delivered loan commitment. Delivery shall not satisfy contingency if accompanied by a notice of unacceptability. So if you're not able to, this talks about if the terms do not, if the terms have changed so much that the buyer no longer wants to go forward with the purchase. That you have to do a different way. So what they're doing here is just talking about once we do have loan commitment, how do we properly do that? I point this out because I have withdrawn an offer because they did not deliver loan commitment, and I canceled the offer within 5 days of closing. Can you imagine your buyer or you and your buyer being in that position where 5 days before closing, because you failed to deliver loan commitment the proper way, or you failed to get it from the bank on time, then now the seller has decided to pull the offer? It does happen. So that's why I want to emphasize that we deliver it the proper way. We have a loan commitment from the bank within the 40 days or whatever day is up here. You have the buyer sign it, acknowledging review, and you have written instructions from the buyer to share it with the seller. And you get that all done with that 40 days, your loan commitment is properly satisfied. Now, there's a special section here. The delivered commitment may contain conditions buyer must yet satisfy or obligate the lender to provide the loan. Buyer, buyer's lender, and agents of buyer or seller shall not deliver a loan commitment to seller or seller's agent without buyer's prior written approval or unless accompanied by a notice of unavailability. So what this is just saying is you can't be delivering this stuff without the buyer giving you approval to go ahead and do that. Now let's talk about seller's termination rights, and then we'll talk about what happens if you're not able to get financing. So let's say, for example, that loan commitment is not delivered on time. Seller termination rights. If buyer does not make timely delivery of said commitment, seller may terminate this offer if seller delivers a written notice of termination to the buyer, and we'll just stop right there. So seller may terminate this offer if seller delivers a written notice of termination to the buyer. So if the seller wants to cancel this because you didn't deliver the loan commitment, just a notice, sent it over, it's done. Just pointing out that the buyer has failed to deliver loan commitment in a timely manner. But this is an important thing to remember. Notice of termination prior to seller's actual receipt of a copy of buyer's loan commitment. So what this is saying is, let's say we get past the 40 days and it gets to be the 41st day, and now you have loan commitment from the bank. You run around, you get the buyer to sign it, buyer signs it, buyer gives you written approval, and you send it over per the terms that they discussed up here. Then you have satisfied loan commitment and the seller cannot pull it. What this pretty much says is once it gets past this 40 days or whatever number of days it is, whoever gets there first wins. So if you're able to deliver a loan commitment prior to the seller giving you notice, the transaction will continue on. But if you're in the process of trying to get the loan commitment, and let's say the bank hasn't gotten the commitment letter yet, or the buyer's dragging his feet, signing it and giving you written instructions, and then all of a sudden the seller gives you the notice 2 or 3 days after this deadline, well, then it's dead. So what this is pretty much saying is if we get past the deadline, whoever gets there first wins. If the buyer gets there first and delivers loan commitment properly, then we go forward. If seller terminates the offer, then the offer is dead. I'm sorry, that's this section here. All right, so now, what happens if within that 40 days, we find out that the financing is not going to be available? This is where we talk about what happens if it's not available. So if financing is not available on terms stated in this offer and buyer has not already delivered an acceptable loan commitment for other financing to the seller, buyer shall promptly deliver written notice to the seller of same, including copies of lender's rejection letters or other evidence of unavailability. So what you're saying is, if we find out that the bank is not going to be able to give you the loan, the bank should really give the buyer a letter that says, we're not going to give you the loan, and this is the reason why. Unless a specific, and then you have to deliver this. Let's see, buyer shall promptly deliver written notice. So you have to do a notice to the seller of saying that you're not able to get the loan, including copies of the lender's rejection letters or other evidence of unavailability. Generally, other evidence of unavailability is, let's say, for example, this interest rate spiked all of a sudden and you're not able to get it at this interest rate that was originally stated in the offer. That would be the other evidence that they would be talking about. Unless a specific loan source is named in this offer, sellers shall have. So unless a specific loan source is named, like I said earlier, Bank of Peter or Bank of America or Wells Fargo, seller shall have 10 days to deliver to buyer written notice of seller's decision to finance this transaction on the same terms set forth in this offer. So what that says is, if you deliver a notice of financing unavailability, the seller could, if they wanted to, finance or become the bank for the buyer under these terms here. I've only heard of it happening once in the 15, 16 years I've been doing real estate, and it was only done by a builder who had the financial wherewithal to be able to do that. That hardly ever happens, but it could. I have heard of it happening. So we need to be careful of that. I think the last thing we want to do is assume that a seller is not able to do something when we come to find out that they are. So seller shall then have 10 days to deliver to buyer written notice of seller's decision to finance this transaction on the same terms set forth in this offer. And this offer shall remain in full force and effect, with the time of the closing extended accordingly. Because the seller has 10 days to decide if they want to do it, automatically the deadline or the closing is going to be pushed out that many days. If seller's notice is not timely, in other words, if the seller does not deliver notice within 10 days, this offer shall be null and void. Buyer authorizes seller to obtain any credit information reasonably appropriate to determine buyer's credit worthiness for seller financing. So what this says is, buyer is telling the seller that, if you're going to finance it, you have the right to be able to look at my credit to help you make your decision as to whether you're going to finance this property or not. So let's go down to this next section here. If this offer is not contingent on financing, so if this is a cash offer, within 7 days of acceptance, a financial institution or third party in control of the buyer's funds shall provide seller with reasonable written verification that buyer has, at the time of verification, sufficient funds to close. So in other words, if you're going to have a cash offer, this is just stating within the offer that within 7 days, I'm going to give you proof from an independent third party that my buyer does indeed have the money available for this. If such written verification is not provided, seller has the right to terminate this offer by delivering written notice to the buyer. Buyer may or may not obtain mortgage financing, but does not need the protection of financing contingency. Seller agrees to allow buyer's appraiser access. This is just allowing access to the property. Buyer agrees that the offer is not subject to appraisal, meaning any particular value, unless this offer is subject to an appraisal contingency, nor does the right of access of an appraisal constitute a financing contingency. So what this is saying is, if this is cash, within 7 days, I'm going to go ahead and provide the proof of funds. Buyer may or may not, just because they have the proof of funds, the buyer still could try to get a mortgage. The seller, if it's not contingent on financing, the seller could still go get a mortgage. Seller is going to agree to allow the buyer's appraiser on the property if they want to appraise the property. Also, with a cash transaction, it's possible that you could make a contingent on an appraisal. You don't have to do an appraisal in conjunction with financing contingency. You can do an appraisal and still have it be a cash transaction. I've done a few of those, and actually it has shown that, through this appraisal, that maybe the person is paying a little bit more for the property than they should have. but at least now that buyer has some good information, they can decide what they're going to do with that. And the appraisal contingency would stay. And I've talked about appraisal contingencies elsewhere, so I'm not going to go into that in great detail here. So that's the appraisal contingency as it appears in the offer to purchase. It's important that, just to recap, this is going to be the basics or the minimum of what the buyer is going to accept, although during the process they might change their mind. This talks about how do you deliver loan commitment. You have to get a letter from the bank that says, yes, I'm going to give you the loan. Number two, the buyer has to sign that loan commitment. Whether there's a space for it or not, the buyer should still sign it. Three, the buyer has to give you written instructions to share all this information with the seller. That can be either an email or that can be a notice. And then four, you have to deliver the written instructions and the signed loan commitment to the seller in one email. They have to be together. You can't have them as separate emails. If you don't do loan commitment on time, the seller has a right to cancel the offer, but you can still get it in after the deadline, provided the seller doesn't give you that cancellation. This talks about what happens if the financing is unavailable. You do have to get that before the 40 days or whatever deadline is, and this talks about how to be able to deliver that. You have to do a notice stating that your buyer is not able to get financing, and you have to provide a letter from the bank stating why they're not able to get financing or why they're not able to finance under these terms that I talked about. Remember, the seller has 10 days to decide what to do with this. So you got to make sure you're careful of that. And this talks about what happens if you're not going to finance, but it's going to be a cash offer. In essence, you just have to give proof of funds within 7 days of the acceptance. So that's the financing contingency. Please, if you have any questions, give me a call. I'm happy to help you with this. If you're working with a transaction mentor or working on a team, go ahead and call your transaction mentor or team leader. Any one of us would be happy to help you. Or if you're just in the office and you see an agent and you got a question, please don't be afraid to stop and ask. So thank you, everyone. I hope you got a lot out of this, and let me know if you have any questions.